This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's an eventful day. It's likely to be an eventful day because it was an eventful last night. I mean, we were not awake for it. We learned about it this morning. I'm Prashant. With me, my colleagues Mangalam and Nigel. Guys, hi, good morning.
Good morning. Well, you often said that Mangalam would come on closing bell when the markets are boring. So I said, no, well, the markets are likely to be interesting today. So let's start on the front foot.
Nigel, you were up last night?
Oh, no ways. Yesterday was a tricky evening, right? You're looking for the moon. You have Tata Steel's numbers as well that are coming in there. So lots happened. But I'll tell you guys, today we have an eventful day because the Fed, the street believes that they haven't disappointed.
Yeah.
India's taking on Sri Lanka today here in Mumbai. And it's the great man, Shah Rukh Khan's birthday as well, So, I mean, it's going to be a good day. I don't think there's any bigger superstar here in India. Self-made man.
Oh, yeah.
Lots to learn from his interview. So, I'm feeling good today.
Okay. Well, only one place we know Shah Rukh Khan will not be celebrating is the Wankhede Stadium. But having said that, cheer for all our boys in blue. And yes, celebrate Shah Rukh Khan's birthday as well. All these things happening today.
Oh, well, absolutely. And always trust Nigel to come up with something.
Yes, it has to be special, right?
So, yeah. It is. So let's just quickly take a look at what you need to know as we kick off another trading session right here. It's a very constructive kind of environment, the backdrop that we left with last night. And the reason I say that is because you've got a sense which is developing, and I'll explain why, that maybe from here on till the end of the year, there is a more positive tactical environment. And why is that? So market expectations of future rate hikes. I mean, nothing happened last night, but market expectations of what the Fed will do beyond November, in December, through the first half of the year, that has dropped sharply. I'm talking about rate hike expectations. So most don't believe that now the Fed will do anything. There were a few holdouts, if you look at mainstream economists, Citi, etc., who were saying that they do believe that the Fed has got more to do. I think many have changed their opinion after what the Fed said last night. Not in the statement, but in the press conference for the most part. So no change in rates. They remain at the corridor remains between 5.25 and 5%. So that's on expected lines. And the commentary is what gave the market a fair bit of optimism. A huge amount of acknowledgement that the Fed has come a long way with these 450 plus basis points of rate hikes in the last 1.5 years, and a sense that we need to just wait it out and not do more immediately. Yields dropped sharply. I mean, I'm just kind of highlighting what happened on the 10-year, but you look at the 5-year, even the 2-year, the nearest, the 2, the 5, the 10, the 30, everything. The 10 lost 17 basis points. We were at 4.92% 2 days back. We were at 4.76. So there's a huge amount of retracement which has happened there. And equities, especially tech stocks, and I think that's got some takeaways here as we start as well, especially, slightly futuristic businesses which are dependent on a lot of capital, which perhaps will generate money sometime down the line. Those are the kind of businesses which benefit on lower interest rate environment. So the NASDAQ was up about 1.6% or so. And again, I just want to sort of wrap this up with a question. The rates in the U.S., bond yields in the U.S. has been the source of so much volatility across other asset classes. And with what we've seen, maybe I'm overemphasizing the point, but I mean, I think the question is valid, it's legitimate, that is that cross-asset volatility because of higher interest rates perhaps behind with the Fed giving the comfort that maybe they're done for the year and maybe, they're done. Okay, so let's just quickly take a look at just one last point. Oil prices from the global arena. We're at $85 per barrel after the 3% drop that we had. Just to circle back to levels, and this is, by the way, $10 off the recent highs. So that's a huge drop that we've seen. Nifty, as of yesterday, it had retraced 61.8% of the 2-day bounce that we saw. Over last Friday and Monday, we had a 300-point bounce. As of yesterday's close, we had retraced about 61.8% of it. And because the environment is constructive, I think it makes sense to look for dips to try and buy it. Yesterday's high was 19,230. We didn't quite get to the 38% retracement of the October levels, but we got very close to it. So that's the next level, which is 19,280. So, nearby both these levels, but those are the near-term sort of nifty levels. On the downside, the recent lows, last Thursday's low is what we need to protect, 18,838. Hopefully that won't come into play once now. From here. Nifty Bank resistance is at 43,348. That's the sort of 50% retracement. We again got to that particular level, then sold off aggressively from that point. And on the downside, the low that we saw on the Nifty Bank is 42,105. So perhaps we can hopefully forget about it. But we'll never say no. But the global environment, especially with what the Fed has done and the yields, etc., rates market in the US, I think it's constructive. The Gift Nifty will come up on your screen, indicating we're 150 point. That's a problem. You get a 150 point gap up if you do at 9:15. What do you do after that? Then you got to take a slightly longish view and not an intraday view to be able to make money to buy that and then kind of chase the market higher. Guys.
Well, the global cues are positive, and the global equity markets like what the Fed has said. So whether you're looking at Brent crude prices, the dollar index, everything, global picture, there's no worries out there. Yeah. The Nifty IT index could be the index to watch today because yesterday it underperformed. And also the Nifty Bank, actually, it's been quite resilient. Even in yesterday's trading session, we did see that index did hold one end up. Data suggests maybe for the day, you maintain a long bias on the Nifty. Don't chase the gap up, but maintaining a long bias by the intraday dip could be the strategy for the day. And I want to pull up two charts for you yesterday. The Nifty ended virtually at the low point of the day yesterday, and it wasn't the Nifty Bank actually that was being naughty. Yes, it did play out weekly expiry, and that was actually quite resilient. Particularly towards the end of trade, we did see a bit of an uptake on that index. Now, you pull up the IT index. That's the one that was nervous going into this Fed event. So maybe the street was expecting a hawkish-sounding Fed chair, and maybe the yields were expected to spike or something on those lines. But that's why in the last hour of trade, you saw the IT stocks did take a bit of a knock. I expect some part of that to get reversed in today's session. Pulling up what the FIs did yesterday, they added short set again, 10,000 shorts for 5,000 longs. And now in percentage terms, the short positioning is at around 85%. But in absolute terms, the net short contracts from the FIs are the highest we have seen all the way since the end of March as well. So that's a data point that comes up for you. Net shorts in the system, I don't think it's a bad thing. In fact, that gives it an additional fillip. If you're not getting flows from the FIs, maybe these short positions will hold the bulls in good stead. Moving to the options data, 19,100 call, 19,050 call. Just take a look at that. The premium comes down from 70 to 17, 115 to around 31. So you just plug in those numbers, you'll get a resistance zone of around that 19,170. But the PCR, because of this writing, has come down to the lower end of the range at around 0.8. We've seen it bottoms out at around that 0.7 odd. But plugging in the premiums that we saw at the high of yesterday, 19,170, we start around that level. That's a resistance zone. We play out weekly expiry today. So the bears are positioned that we don't get past that. On the downside, 18,750, that's the near-term support. And those are levels for today. The Gift Nifty is suggesting a gap up. Don't chase the opening, but maybe look to buy the intraday dip. And you need to maintain a long bias. Going by all the data points we have, the shots in the system and the IT index could be the one that performs well today.
Well, Nigel, looking at the levels, irrespective of the news, etc., it's telling you that over the last few trading sessions, the market has firm support between 18,950 to around 19,000 itself. Just look at the lows of the Nifty, and this is at a time when there was extreme volatility in our markets as well. All the lows have been contained around that 18,900 to 19,000 mark itself. Yesterday as well, the low was 18,974. And we opened, closed marginally above that. So that's telling you that buying closer to that 19,000 mark would make you money. And the Gift Nifty opening is suggesting that you will make money. The question is what happens now? Post the Fed meet outcome, like Prashant said, there's one chart that tells you there's so much risk on in the market. Yes, the 10-year yield cooled off to 4.7. US volatility index, the CBOE VIX, fell by about 7%. NASDAQ, which is again a risk on sort of index, up 1.6%. Brent down $80 to $85. And above all, the key gauge of risk, the cryptos, that market did well as well. Bitcoin is well above 35,000 now, holding with a gain of over 3% itself. So with risk on trades, what are the sectors and indices that work? Nigel did speak about the IT index doing well, having had some shorts ahead of the Fed event itself. So that unwinds. Metals index is something that I'll be watching out for. And finally, we'll keep an eye out on a couple of these new age companies as well. Every time there is belief that maybe rates have topped out, all these new age companies start to do well. So those are 3 sectors that I'll be watching out for. And talking about sectors itself, over the last few trading sessions, the mid caps have done relatively better after the big drubbing that we saw over the last week, etc. So let's see whether mid cap and small cap indices come back too in trade. The 2 things that we'll be watching out for. One will be the FII action in cash market. I mean, over the last few trading sessions, we've seen the FII sell over 20,000 crore worth selling in October as well. And November, the first trading session of November, we saw the FII sell almost 1,800 crores. So if they were to reverse their positions and start buying back into the Indian markets, then the move would be a lot more pronounced on the way up. Secondly, it's the Nifty Bank weekly options expiry today, the first one for the month of November or the November series itself. The last couple of Nifty weekly expiries have gone in favor of the bears. Can this one, go in favor of the bulls itself? And perhaps we see some more short covering in our market. What would lead to that? Well, if the Nifty Bank crosses the 200-day moving average and stays above that, we would see a further up move on the Nifty Bank, and as a result of which, the Nifty itself and the Nifty. We have seen some resistance around that 19,200 to 19,250 mark. If we sustain above that, there is room all the way up to the 20-day moving average, which is 19,450 on the Nifty. The question is whether it sustains the opening gap up or not. Finally, from a global news standpoint, and perhaps as an Apple fanboy as well, I'll be watching out for Apple's earnings. Yes, because the street is positioning itself for weak numbers this time around. Revenue is likely to decline by 1%. But everyone knows that because the iPhone 15 launched towards the end of September. So the commentary on what demand was like for iPhone 15 will be very, very crucial. Not only because, the way Apple sees demand, etc., but the impact that it has on the overall consumer sentiment. And like Reliance, when Apple moves in the US, everyone knows, okay, things are good with the consumer sentiment. So that's something we'll be watching out for too.
They have a contribution of my lowly new iPhone as well. So
oh, you bought one?
Add that in. Not the 15.
So irrespective.
Low contribution, but anyway.
Well, okay, so that's about the trade setup. Let's